Hello and welcome to episode 102 of Decentralized Revolution, a podcast from the Libertarian Party Mises Caucus and Mises Caucus PAC. I'm Liam McCollum and I'm your host for today. And my guest today on episode 102 is Luke Tatum. We're going to be talking about his new book and the infinite banking concept. So I'm going to bring him in right now. How's it going, Luke?
Hey, Liam. Good to see you. I'm doing well. How are you?
Yeah, I'm doing great, and I really appreciate you having this conversation with me. Figured I'd just let you introduce yourself, kind of give the audience a little bit of your background, how you got interested in liberty and economics, and then how you ended up finding infinite banking.
Sure. Yeah. I mean, I would not be in the infinite banking space if not for the liberty space, right? So it was definitely a liberty first kind of a thing, as it should be, right? But my name's Luke Tatum. I am the founder, CEO of Perfect Spiral Capital. That is my financial firm that deals with infinite banking. And I'm also the author of the Amazon best-selling book, Between the Lies: How to Reclaim Your Future from the Banks and Wall Street, which is 99 cents for the Kindle version. If anyone is interested in reading it, you can check that out on betweenthelliesbook.com. You can get to my regular site on perfectspiralcapital.com. But yeah, a little bit of my backstory. It's actually a little silly and boring, but we were, I say we, my wife and I, we were then dating, now married, but we for early on in our relationship, we're interested in checking out the whole raw milk thing. It's like, oh, cool. There's direct to consumer farms out there in some places. We're from smaller towns in Texas, and so we found one nearby. We get to know the people that operate one of these farms, start buying the milk, et cetera, kind of integrating into that culture a little bit. And they put on a sort of an event one day where they said, hey, we're going to have vendors and speakers and all this stuff. So we go out there, and there was a guy from the Farm to Consumer Legal Defense Fund, which is a really cool organization, helping farmers not be railroaded by, the FDA and similar agencies. And so he was out there talking about Ron Paul. This was years ago. And so before Ron Paul's last run for president, and talking to him, and he's like, oh yeah, Ron Paul's the only guy that actually cares about any of this stuff in Washington. And so I discovered Ron Paul through this vendor at a local farm. And then it's like, okay, YouTube videos, Ron Paul starts recommending, you should maybe read some books, right? I had given up on reading for many years because school beat that right out of me. And so start reading The Law by Bastiat. And then I dove as far in as you can and read Human Action by Mises. And I read Man, Economy, and State by Rothbard, and et cetera, et cetera. And that's, for video viewers, like my bookshelf back there is a lot of that stuff. But yeah, so that's kind of my story in a nutshell. My wife and I both went from sort of kind of politically aware a little to like activists kind of in the Ron Paul world to anarchists. And so, here we are.
Yeah, well, that's awesome. It always seems to go back to Ron Paul, at least people who are younger. I know my civics teacher in high school introduced me to libertarianism, and he had a photo of Ron Paul at the front of his classroom. So I inadvertently came to libertarianism through Ron Paul, but he was introduced to libertarianism in the 2012 election, and now here I am. So it's
awesome.
It's a beautiful story.
Yeah,
and that's what we're trying to do with the Mises Caucus. It's the Ron Paul Revolution 2.0. But to get into your book and infinite banking, I really appreciate that your kind of interest in this is grounded in Rothbardianism. And I think it would be important to kind of provide some context today for the listener who maybe has never really looked into finance before and really viewed the current financial environment through a Rothbardian lens. So we recently just saw that the second largest bank in U.S. history failed. And many people are probably freaking out. And you actually have a chapter in your book about banks and why banks aren't your friend. So I'm curious if you can just respond to this crisis so we can provide some context for the listener who's like, infinite banking, what is that? Relate all of this to what we're seeing right now.
Sure. Yeah. I mean, we can definitely start there, Liam. I mean, this is a good, it's honestly like, obviously there are bad things happening in the world, right? Like there are people's deposits at risk, and there are things that are negative that are occurring. I'm honestly very excited when I see these banks in trouble and thing, because I see the kind of immoral foundation that the whole system is sort of built upon. And so, like, to me, it's like it couldn't happen to a better group of people, right, than these ultra rich bankers and whatnot. Like, not that I'm despising them for being rich or whatever. It's that the system that they're perpetuating is, they're making money out of nothing and lending it at interest, right? So that's bad. That's a moral catastrophe. And so the thing that's going on now with the banks being in trouble, like, I won't bore anyone here with like what interest rate risk is or any of those things and get like extraordinarily technical about why they're in trouble or anything like that. But the simple fact is that we have what's known as fractional reserve banking. Fractional reserve banking means that not all of the money is really there, right? There is a fraction of what they say that they have that's actually on reserve. And so if everyone shows up at the same time, or even a majority, or even a very small number of depositors show up all at once and say, hey, where's my money? It's not there. And so that's a problem, right? And that leads to what's called a run on the bank. And it's bad news for people, right? We saw this in 2008 and that whole fiasco, and we're seeing it again now. And so it honestly, it's kind of an interesting standpoint for me, because I wrote this book and I talk about banking and how the bank is not your friend, and how all these underlying problems exist. And I wrote it before these bank runs and things started to occur. And so, I wrote it because the stuff that's in there is true. Like, one of the things I'm proud of with my book is it's well documented. There's lots of links and things. And I even took the time to archive on archive.org all of the backlinks for all of the stuff. So it's always going to be there. You will have something to click on, if you click those links, no matter what. But the, it could have been 10 years before this sort of thing started to happen. The fact is, like, these underlying conditions are present, right? And we can get into the nitty gritty as much as you want to, Liam. I'm happy to talk about, the specifics of the system and why it's bad, and all those things. But, when we're talking about, okay, if I go to get money out of the bank, they might tell me, or if we're talking about, well, I have a mortgage and I still owe $250,000 on a house, and the bank might be in trouble, so they might go ahead and demand full repayment next week. Like, those are really, really scary things. And so that is why I make a case for not banking in a regular bank, a fractional reserve bank, because there's significant risk involved with that people are, you have this catchphrase, right? Like, it's, you take your money to the bank. You can take that to the bank. People talk about the bank as being the safest place on earth, and your money's not there, man. It's just not. So maybe that's a good, a good first pass answer, and we can kind of dig in from there.
Yeah. And I mean, in March of 2020, we saw that the Federal Reserve actually got rid of all reserve requirements. So, I mean, legally,
Correct.
there is no requirement that they keep any of your money. I mean, there might be practical reasons why they still have a fractional reserve or whatever, but legally they are not required to. And most people have been saying for a while that banks are required to keep at least 10%, but that's just not the case legally anymore. So it is a very scary reality. And while I was reading through your book and while I was discussing with Michael Heiss and everyone who requested that I interview you, they were saying that I was actually a prime candidate for infinite banking. And quite frankly, I didn't know enough about it. I'm 22 years old. I hardly know anything about finance. I've just now started to think about it. So I kind of want to approach the interview like you're approaching someone who's 22 years old, who is about to start maybe investing or looking at life insurance. And first, like, if you were to sit someone my age down and explain to them what to do with finances, I'm curious if you can explain what the status quo would recommend. Like, what is the normal approach that people my age might take at my age? Like, what obviously people might recommend a savings account, a credit card, things like that. But why don't you explain the status quo and then dismantle it?
No, I think that's a great setup. Yeah, that's an awesome approach. And I know exactly what they'll tell you because I was trained by those people and I know what they told me to tell people. Right. And so like I know what they'll tell you if you go into Charles Schwab or whatever other place. And so yeah, what that's gonna look like. I mean, obviously everyone has some kind of bank account, right? Like when you can, your parents or whoever is probably going to encourage you to have some kind of bank account, right? They don't want to be paying for every single thing in your life anymore. They want you to do it yourself. You have to kind of come up with how much money is going to be needed for different things, and so you have to reconcile, right? It's like, how do you balance a checkbook? That's what people used to say. I don't know if anyone still says that, but the idea is that, okay, you make some money. What do you make? You make this much money a month. Okay, you should take percentages. You should say, okay, this is for housing. This is for, fun money. This is for your necessities, your utilities. You should budget, and you should budget month to month and master that skill. And then you should be setting aside at least 10% of your income for the future. That's how that's going to frame up. And so what does that mean? Well, for a financial services company, a standard financial services company, you're going to have a recommendation that you put it in the stock market. That's just what it's going to be, right? Exactly what the ratios are, how much is in equities, how much is in bonds, those kind of things. That's going to be up for debate. It's going to depend on your risk profile, et cetera, et cetera. But it's going to work like this. Okay, you should get a job. You should get a good job that offers a 401k. Preferably, they offer a 401k with a match. And then when they match, it's going to be a certain percentage. So, okay, if you contribute 5% of your income and they match 5%, wow, that's great, because now you get 10% going into the stock market, right? 10% of your income. That has various assumptions and flaws built into that. Break some of that down in the book, why that's not really actually what's happening. But that's what they're going to say. And so the 401k, and maybe your employer doesn't have a match. Maybe they match 3% and you're contributing 5%. Maybe whatever, the ratios change, the numbers change. It doesn't particularly matter. But they're going to say, take the free money. So max out your contributions or contribute as much as you can get a match on to your 401k through your employer. If they offer a Roth 401k or some kind of Roth IRA, then you should max that out too, right? Because you just want to do all these tax qualified retirement plans. That's the advice. And then beyond that, so when you're really successful and you really start making strides and you can afford to max out those accounts and everything, your income keeps going up, you're doing amazing. Okay, now you need to bring it to us, the Charles Schwab, whoever, whatever financial services firm, and we're going to build you a stock portfolio. We're going to set up a traditional IRA. We're going to set up, whatever cool investment tool, or we're going to start saving for your kids' retirement, or your kids' college education, 429 plan. I'm just saying everything wrong today, Liam. 529 plan. And they're going to just throw as many of those tools, those tax qualified kind of niches that the government has created over the years at you as you'll take. If you keep buying them, they'll keep selling them. And that's just how it is. Again, the specifics vary. It's like, do you want to put it all in the S&P 500? Do you want to buy individual stocks? We'll build this really cool list of stocks. And guess what? The list that they build is going to be a bunch of companies from the S&P 500. So it's the same thing. They, what have you. Everybody's a little different as to how they're going to approach these things. But that's the advice. Load up on these tax qualified plans, et cetera, et cetera. And then you'll be sure that you have all this money. You're going to have so much in retirement, man. And you can just kick back and you can go on vacations and all this stuff. Well, okay. You can do that if you want. And that guarantees that you're going to have to wait until you're the government certified retirement age to start tapping into your money and start really, accessing those funds and doing all this stuff. So you're giving up a lot of years. In your case, 22 years old, that's a long time, right? So, okay, cool. I'll start throwing all this money in this account and you can't touch it until you're 59 and a half years old. Otherwise, you have a big old penalty on top. And you're interrupting the compounding nature of that tool, right? So that's the part they don't tell you. They tell you, oh, this is for the future, et cetera. It's going to help you retire. But things come up. You know how many people take 401k loans and finance like a home renovation or buy a car or do different things like that using a 401k loan? A lot of people. And when you do that, you've broken the system. Okay. If you imagine a 401k as this continuously compounding vehicle where your money is always reinvesting and building and it's always going up and up. If that's what that's wrong, but if that's what they've kind of sold to you as this idea, well, if you take a compounding tool and you pull a bunch of money out of it, you broke the thing. You reset the compounding. You've destroyed that. Well, the real truth is it's not even a compounding tool. The stock market doesn't just go up like that. That's not what it does. It goes up and down all the time. And so you don't have, I swear to you, they will say, compounding. They'll say that in the conversation, but that's not what it is. It's just not correct. And so that's where something like the infinite banking concept, dividend paying, permanent whole life insurance policies from a mutual company, that's where this kind of can come in, because I'm not telling you don't buy stocks. I'm not telling you don't invest money. And as a matter of fact, I'm not telling you that a life insurance policy is an investment, because it isn't. It's a savings vehicle. It's a way to accumulate wealth over time. And so it's not that you shouldn't save for the future and invest for the future. You should do those things. But first, you should back up and say, okay, where is my money going to reside? And the choices are under your mattress in cash, which is devaluing all the time. Cryptocurrency, which has its own, there's a bunch of different options. There's a bunch of different fluctuations in value. There's a bunch of different use cases and considerations there. It's not to say that crypto is bad, but there's limitations on that. Not every single place can you just walk in and say, well, I've got some, XRP here. Will you accept this for my whatever that you're trying to buy? It's just, there's some layers to that, right? And then, of course, you could put it in a bank. The bank, as we're talking about, has some problems, but it is very convenient. You've got a debit card and those sort of things. And then you could put it, and again, this is my mind-blowing revelation, you could put it in a life insurance policy. Why should you do that? Well, because it's always increasing in value all the time. Okay. And it's a 100% reserve system. So when you put your money in a bank, as I outline in the book for anyone that picks it up, they will take, you put $1,000 in, they're going to make a new $900 loan to someone else. So then there will be $1,900 because you deposited 1,000. 900 loan to somebody else, 1,000 that's sort of there. And then they'll, go through their reserve requirements and they'll move that to another institution, et cetera. But at least at the beginning, it creates an extra $900. And then when that gets repaid, they loan it out again. When that gets repaid, they loan it out again. It keeps doing this thing where they make new money all the time. That is fueling inflation, and that is devaluing the dollar all the time. Every time somebody puts money in a savings account.
And a secondary effect of it is that I think it's actually it's incentivizing people to participate in this gambling system that you've described, where they're putting their money in the stock market because they are losing value. Their money and their savings are losing value. So in order to keep up with the first receivers of this new money, they have to invest it in the economy and hope that it appreciates in value over time. So I mean, would you say that they kind of the banks and Wall Street in this way are helping each other out?
Oh yeah, I mean it's a huge con game. Like, I mean, in no uncertain terms, right? Like that's actually, I'll hold up my book for anyone that can see it. That's where the cover idea came from. Like this line, or whichever line you want to use, one of them is the banking system, one of them is Wall Street, right? And so you kind of are told to kind of stay in your lane, right? And operate within this framework, and we're going to keep you kind of on track and all this stuff. And it's exactly right. Right? The mutual fund industry and all of this stuff is perfectly set up to receive people who are like, wow, wait a minute, I don't want to put all this money in the bank. And the banks are perfectly set up to receive people who are like, wait a minute, the stock market's a casino. I'm just going to put all my money in savings, right? Like they just feed off of each other all the time. And, I'm somewhat critical of people like Dave Ramsey, in there. Like we're Dave Ramsey people, or we were for a few years. We paid off our house, et cetera, et cetera. And I love the idea of just pay cash for everything, right? Just keep money physically close. But when it's devaluing, when the inflation rate is 7 or 9 or 14%, like, okay, I mean, you maybe want to do something about that. But the stock market is not necessarily the answer, right? I've got friends who are day traders. If you know what you're doing, then do it. But the assumption that's been laid out at society's feet is, okay, in order to fight inflation, because inflation is this mysterious thing that is always happening and we can't do anything about it, you need to put money in the stock market. You're going to have to put money in the stock market to beat inflation, right? And that's not correct. So yeah, that's kind of how that dynamic goes. But the insurance companies are not banks, right? That's one of my big points. Is this is not the advice they're giving you. Some financial services places will tell you like whole life insurance is super great, and you ask kind of why, and they're like, well, because it's super great. They don't really explain what's so great about it. It's like, oh, but it has cash value. Like, and there's this very, very surface level analysis out there that you'll see sometimes of, oh, you're going to make all this money. And that's not the point. The point is that when you put money in one of these specially designed, what we call an infinite banking policy, then it is going to earn money. It's going to increase in value for you forever, even if, and this is only true with what's called a non-direct recognition company. Again, this is why you have to have a professional do this for you and help you navigate it. But it's going to increase in value all the time, even if you take money out of that policy to do other things. Okay, so you will, in parallel, at the exact same moment, have an increasing cash value in this policy all the time. And you can go invest your money or buy a car or whatever, finance the, home renovation project. You will get the growth in the policy, and you will get the other thing. Let's just say it's a car. If you go buy a car just in cash, Dave Ramsey style, or worse yet, take a loan from a regular bank and you put 5% down on a car, then you hand money to the car dealership. They give you the keys, right? That's it. Next year, you didn't earn anything on that money. You just have a car. 2 years later, you didn't earn any money from that money that you used to have. You just have a car. You can do it differently. You can get increased value over time, helping you to fight inflation, and you can get the car, right? It just requires discipline, savings, understanding upfront. You have to understand what you're doing before you can, apply this principle. And so that's kind of where I get into in the tail end of the book is like, you've got to take responsibility for these things. You've got to understand them. And then this is the power of understanding and implementing these over time. You can use it to buy crypto for all I care, right? It doesn't matter what you buy, but you should use this first before you go do those other things. That's my advice.
Yeah. So the first chapter of your book, and I think really your entire book, is about taking responsibility, and you offer up an acronym. And I actually wanted to read this quote. I think it's from Nash, Nelson Nash. Says people just don't play their proper role in the scheme of things. They have abdicated their opportunity or responsibility as it pertains to the banking function in the economy. They're depending on someone else to perform that job, and that character in the play is making most of the money. So I just wanted to give you an opportunity to explain like the acronym that you offer up in the first book. I believe it's TRUTH. It's like a 5-step almost program to liberate yourself from the banking system as it currently stands. So do you want to break that down?
Sure. Yeah, absolutely. So it's called the Truth Blueprint. Sorry, I'm misspeaking. Truth Blueprint. And so truth is the acronym. The first letter, T, take responsibility. R is reclaim your money. U is undo your debts. T is transcend your expenses. And H is help others. And so what that basically breaks down to, what that means. So take responsibility is all in your own head. Like you've got to just get past this, the government or Wall Street or the banks or whoever you like are counting on out there in the pre-constructed world of this financial narrative that we're all kind of stuck in. Well, whoever you think has got your back out there, you probably need to re-examine that, right? Like, and just shift all that responsibility from all those other people onto you and figure out what you need to do to, transform your own or your family's or your business's life. And so that's step one. Step two, reclaim your money. That's infinite banking. I mean, I'll be just blatant with it. That's what that is. It's figure that out, understand the principles involved, understand that there is a better way, and implement that. And there's lots of ways to implement it. It's fun. I have fun every day talking to people about implementation and doing that stuff because everything is a puzzle. I get to solve it with people, right? And then U is undo your debts. And it's literally true that with the infinite banking policies, you're using what's called a policy loan in order to access funds from this. That's how you get the double growth, so to speak. Like you can use the money and keep the money in the policy at the same time is what's going on. It's because it's called a policy loan. But undo your debts is about undoing your debts from all of these other institutions where you don't get to play a role in the growth of that company. Like the example I beat up on Bank of America all the time, right? Because why wouldn't you? And so Bank of America, like you're not on their board of directors. You don't get a bonus when they make money. They don't care, right? I mean, they don't care about you. They just don't. A mutually owned life insurance company is owned by the people who own policies. So when they're profitable, they pay you. It's just, that's how it is. They're not gonna not pay you. They might not be profitable, but a lot of these companies have been profitable every single year consistently for 100, 115, 130, in some cases 150 years. right? So longer than the New York Stock Exchange or the S&P 500 or any of these things have been around. Every year they've been profitable. But again, you can't promise that the dividend is going to continue. It could, and you would stand to gain if you were set up in this way. But you get rid of those other debts to those other institutions, right? You pay the interest to yourself, and that's a whole big involved idea. We don't have to get into the nitty gritty on, but that's what you should do. If you're going to pay a payment on a debt, you might as well pay a payment on a debt to a company that you own that pays you when it's profitable. I mean, that makes a lot more sense to me than paying Bank of America. And so that's that. And it's kind of like how it makes financial sense to do that and how getting rid of those other debts is going to reduce your expenses. And then T, transcend your expenses, is about passive income. It's about finding and understanding investments. Again, if it's the stock market, great. But there are a lot of other things. And I just have a non-comprehensive list in there of other ideas, other ways you can make money, things that have varying levels of involvement that you can do. And, then you don't need an IRA to handle those things. You just go do them. And you can retire or whatever a lot earlier in life if you're kind of taking advantage of these different steps and how they work together. And so transcend your expenses, you complete that step whenever your base living expenses, your required monthly bills that you've got to pay are all covered by passive income sources that you've developed, that you understand. And then you're financially free. Like, what's left? It's growing that, doing charitable work, doing political donations, whatever it is that's on your mind. If you're from a position of financial strength, all that stuff is a lot easier, right? You don't have to go out and come up with some way to come up with money all of a sudden to like help a cause. You've got money. You're just standing by waiting for opportunities. So that's what I would like to see more people, especially in our movement, be in that position. And then H, help others, is spreading this. Like, if you imagine how powerful this idea is or this system, even the 5 steps for one person. Okay, what about a husband and wife both doing it? Okay, what about a husband and wife and 3 kids, all 5 doing it? I've got some families that I've got grandfather, father, son, brother of the middle, father character, right? So like multiple layers of people all practicing this. And like the amount of intergenerational wealth that is creditor protected, can't be touched from a taxation standpoint, all of these different things, like it's a huge amount of money that builds up in these things just by virtue of time passing, right? But just because you decided to start doing it, there's this massive amount of money that builds up over time. And if that appeals to me, but you have to have a long range view. You can't go, well, I want to make, 2x my money by next year. That's not how it works. It's not an investment. It's a savings vehicle. It's just a better savings vehicle. And so I feel like I'm being long-winded, but those are the 5 steps, right? You get to the end and you're doing your estate planning, your charitable giving, your donation to the Mises Institute when you pass away, or whatever it is, right? And you come a long way by the time you get to that 5th step.
Yeah, I wanted you to break that down because I do think it is important, and I think awesome that the acronym is TRUTH, because really our movement and the understanding of the Austrian business cycle is based in truth, and it's really trying to unmask the illusion of the current system. The fact is that the banking industry is built on an illusion. It is false. It is false money. They print fiduciary media and they make it seem as if more money exists than there really is, and then of course it all comes crumbling down, and that really is the source of our system. So I really appreciate that you labeled it truth. And I just wanted to give you the opportunity to, explain infinite banking from the ground up. I got a question from someone on Twitter that wanted to know, like, what are the ideal parameters to start? Like, if you had the ideal candidate with a certain amount of savings, certain amount of debt, early in life, and how much cash should they have to start? And then from there, if they sat down with you, I guess, what would you do to explain what this program does with your money, the mechanisms at play? I just want to build from the ground up. So the person
Sure.
who doesn't understand anything about finance, and I'm guilty of that. I am like Michael Heiss said, I am a prime candidate. So I just, yeah, I want you to explain it to me like I'm 5.
Well, I don't know about 5, right? Because I'm going to use the word interest and stuff. So
Yeah,
interest is a really hard thing for
it
like
is.
at a certain point to understand. Which, if anyone has really young kids, this is an awesome tool to teach kids how finance and things work, right, at a very young age. Because so, and again, I'll get back to answering your question. I'm sorry, this is a sidebar, but like if you have a family bank, which is a life insurance policy or series of life insurance policies, then your kid who's 5 or 9 or whatever wants to buy something and they don't have any money. I don't know if you'd pay an allowance or what have you, but they don't have any money. They want to buy something. It's like, okay, you're going to take a loan out of the family bank, right? Let's talk about interest. So if it takes you this long to pay it off, there's this much interest. If it takes you twice that long, there's more interest, right? It and how it grows and all of those things. It's an awesome tool. One of the great things about this, though, is you get to control that, right? If you go into a bank, it's going to be, okay, I'm signing up for a 30-year mortgage. You have this payment you have to pay. And the first payment is going to be mostly interest to the bank. And you kind of scale it down. You make extra payments and you really hustle and you get rid of that debt over time to try to reduce how much of your money is going to interest to the bank. Infinite banking or policy loan from a life insurance policy is the opposite. It's I loan $10,000. My balance is $10,000. It accrues interest every day at a fixed rate. And then, so, a few cents, let's just say it's 5%. I'm not good at doing math in my head, but do 5% of 10,000 divided by 365. That's what that is. It's every day it goes up that amount. And so if you pay back your loan, maybe you needed a short-term cash break, $10,000. Okay, cool. You keep your loan out for 2 weeks. You have not paid very much in interest. I'll just say that. It's not a payday loan. You've got the money. You're just tapping into it and you're making sure that the company you loaned it from is not taking a financial hit by loaning you the money. That's really what you're doing. Okay, let me back up. I'll build this up from the ground up. So to answer the question on Twitter, you can have a very small budget to get started with this. There's a lot of times, I use large numbers in my book because large numbers are more exciting than small numbers, right? If I sit there and say, okay, you're paying $50 a month into this thing, it's just, nobody really gets excited about that. But my own policy, my first policy was $30 and I believe 68 cents a month. And I still have it because it's my oldest policy. And these get more powerful, more interest, more compounding effect over time, right? So the longest one that you've had is going to be your most efficient from a growth standpoint, all things being equal. So I'm going to keep that policy. It's I got to pay the premium in September, and I'm excited to pay it because when I pay my premium, I get a dividend. It goes up. It's awesome. And it happens every year. But if you're just getting into this, for the first time, if you're just starting and figuring out, like, what do I want to do here? Okay, you want to start with some percentage of your income. It doesn't have to be a percentage of your income. It could be just some made up number, but let's say it's 5% of your income. You want to be really conservative. 3% of your income. I really don't care. And I tell people this, on new client calls. I say, I don't care what your budget is. You're steering the ship. You tell me what your budget is. I'm not going to sell you something that's outside of your, reasonable financial range here. But the idea is that you take this, you're paying what's called a premium payment. That's your, just like you pay premiums on homeowners insurance or premiums on your car insurance. It's an insurance premium payment. But this is a whole life insurance contract, which means that there is a death benefit that will be paid someday, as long as you are, taking out the policy in good faith, you didn't lie on your application, things like that. There's a couple of exceptions, but really people make up things that are not exceptions when they talk about whole life insurance, and I've never understood that. They're very, very, very solid instruments. And so, but you take this policy out, and let's just say I'm going to make a very small, right? Say it's a $10,000 death benefit. It's a very small policy. And you can do that. You can have a $10,000 death benefit policy. So you are paying a premium every month or every year in exchange for this death benefit of $10,000 when you die. That's the difference between term insurance and whole life insurance. Term insurance pays if you die within a period of time. Whole life insurance pays when you die, regardless of how long that is. So really, technically speaking, it's 121. So if you're 121 years old and still alive, they will hand you a check for your death benefit because you have reached the end of the contract. But, let's just assume most people are not going to make it that long. And so when you die, they're going to hand you this death benefit check. Now, if they don't ever pay a dividend, ever the entire time that you're alive, then you'll have a $10,000 death benefit that'll pay. But if you're utilizing a kind of custom designed policy, if you're working with an infinite banking practitioner, which there are many, not just me, you can go to infinitebanking.org and use the practitioner finder and find someone else if you don't like me. I do business in a lot of states, but it's your preference, right? I don't want to work with anybody who doesn't want to work with me because it's a lifetime partnership. And so you go on and you pay those premiums, and your dividend is going to, when a dividend is declared, the dividend will be used to buy additional death benefit. So the first dividend buys more death benefit. Then you don't have a $10,000 death benefit check anymore. You have a $10,650 death benefit check when you die. And then it happens again next year, and again next year, and again next year. And then you have this other component, which we call paid up additions. And forgive me, we're getting into the technical stuff now. But the paid up additions are miniature life insurance policies. Okay, so you have a $10,000 death benefit, and then you buy like another $500 of death benefit. Okay, then you buy another 500, then you buy another 500, et cetera, et cetera. So through these two mechanisms, the dividend and you buying mini policies, paid up additions, you're growing the death benefit. The larger the death benefit, the more of the company you own. And so the more of the profitability you earn year after year when they pay a dividend. And so that is how it is a compounding tool. If you assume that they pay a dividend every year, then it looks really nice. If you assume that they don't, it looks kind of slow, but it's going to be somewhere in between those. Dividends fluctuate as the profitability of the company fluctuates. And that's a whole separate conversation. We could do an hour podcast on how dividends work, right? But that's what's going on. And so the first couple of years, there's definitely less money in that policy than you put into it. Because guess what? You bought a product. You bought a life insurance contract. You've traded money in exchange for a thing, right? In this case, it's a promise to pay a future death benefit. But if you're building it in the right way, you understand the tool, et cetera, 6 years in, 7 years in, 8, 9 years in, it depends. It depends on the health of the individual, the age of the individual, et cetera, et cetera. At some point, there's going to be more money in that contract than you have paid. And so you have this non-taxed gain inside this policy, and you can use it over and over and over, right? If you have this little policy and it's grown up and you've got $80,000 of cash value after a few years, several years probably in that case, then guess what? You can take that and you can go buy a car with it. And when you pay off that loan, you've got all the money that you loaned out and all the growth that happened while the money wasn't there. And it does what it would have done if you hadn't taken the loan and bought the car. And so this is using the same dollars over and over. It's not really, but it is. You're taking a loan, buying a thing, repaying it, and it's all there again, right? As opposed to saving up in cash, right? Your bank balance, I don't know which direction I should orient this. Your bank balance goes up. You have $20,000. You buy a car. You have $0. You save up. You buy something else. It drops to zero, right? This doesn't do that. This gets better every year, no matter what, at a faster and faster rate. Because the thing you have to understand about compounding is the very last year is the most profitable year, right? So you're gonna have this gigantic gain potentially on this policy when you're 97, right? And that's gonna go to your heirs tax-free because life insurance is not taxable unless you have a huge estate, talking multiple millions of dollars right now. And, of course, I'm not giving financial advice, I'm not giving tax advice and what have you, but under current law, that's what it looks like. And so, I don't know, am I answering your question? I feel like I'm just rambling.
Yeah, definitely. And maybe, I don't know if this is a good question, so I want you to take it wherever, but maybe so the audience can better understand, would it be good to maybe talk about, since we're speaking about responsibility here, we've described what the irresponsible thing is when it comes to the banking industry and Wall Street. And now you've unpacked what we should do with the infinite banking concept. But is there a way where if someone were to go down this path, they would be irresponsible with this type of program? So can you maybe explain what the worst candidate, I guess, for an infinite banking concept might be? So like, what if you were to go down this path, what is the risk and what should you avoid doing?
Right. Okay. That's a really, really good question. I'm glad you're asking that. So that's why step one is take responsibility, right? Because if you have not taken responsibility, if you're not willing to commit to the fact that interest rate, like the interest rate is a universal thing. Okay. The interest rate is not something that the Fed makes up. The interest rate is the price of time. Okay. And so this whole thing, my favorite Nelson Nash quote, I'll butcher it if I try to say it verbatim, so I'm not going to. But it's the idea that there's always an interest rate. You're always paying an interest rate, no matter what you do. If you go pay cash for something, you have given up the interest you could have earned, like we talked about before, right? So you get the car, you don't have the cash. You gave up all future income that cash could have generated for you. And so it's not to say that a car today really costs $150,000 because of the interest or whatever. I'm not saying that. I'm saying that you either get the car or you get to hold on to the money and get an interest rate. Well, this is a way you can get both. It's the only way that you can get both, the interest and the thing. And so, but even then, you've got to take a policy loan to do it. And so let me answer your question directly. The worst candidate is someone who wants to use this to get something for free, right? To make something out of nothing, and who does not want to pay back their policy loans ever and all of those things, because it is a sense of responsibility that you have to maintain. Now, you can keep a policy loan out. Like, I haven't talked about the loans that much. A policy loan from an insurance company is a contractual right. You have first access to this money even before the insurance company. If you request a policy loan, they must give it to you. It's not, well, my income is down and, so they're not going to give me as much as I want. And, all this stuff like a regular bank, like when are you going to pay it? How much are you going to pay a month? All these things they have to ask you. The insurance company does not care. They literally do not care. They will send you a letter and say, you have a loan out for $10,000. If you want to, you can write in this blank how much you want us to bill each month, and we'll automatically, take a debit out of your bank account to pay for it every month. You just write whatever number you want. It could be $5. It could be $100, whatever you want. I don't do that. I pay loans at completely random intervals. I can. The interest rate is, the interest is accumulating day after day after day. I don't care because there's an interest rate all the time, and it doesn't matter whether I have a loan out or not. So, and that's a weird way of thinking. Like, people look at me weird when I say that. But the person, so I was just actually this morning talking about this in Becoming Your Own Banker, the book that Nelson Nash wrote, where he talks about becoming your own banker, right? It's that a very descriptive title. That is where the infinite banking concept name comes from. It's from that book. And so he talks about the First National Bank of Midland, Texas. I don't remember the year, but the First National Bank of Midland, Texas used to be a very, very successful bank. And what happened? A lot of the people who were running that bank started to give themselves loans at insanely low interest rates. What do you think a bank does if they don't earn any interest on the loans that they make? They go out of business, right? Because you can't get away from the fact that there's an interest rate. There's a price on time. And if you're way under what the price is, you're causing problems. And so don't try to do this as a way to make up a bunch of money that didn't exist before. Don't try to be a regular commercial banker who's in the fractional reserve business. We're trying to condemn that as a moral evil, or at least I am. So don't do it, man. That's the simple advice. Do this in a respectful way. What Nelson Nash would say is don't steal the peas. If you run a grocery store, don't give your employees free merchandise. Don't steal from your own store. Don't ruin the thing that you've taken all this time to learn about and understand and set up and get underwritten for. And, don't put forward all this effort and then mess the thing up 1 year in, right? It's gonna be a phenomenal asset for you over the rest of your life. You have to respect the tool. It's like the same thing with, if you buy a sports car, you can't just treat the thing like junk. It's going to be junk if you do that, right? So that's the idea. And I know I'm kind of keeping it vague. I can ramble for a very long time on the really, really fine details. And, I see people's eyes glaze over, so I'm not going to do that with you, but that's it. You just treat it with respect, treat yourself and your own finances with respect, and you're going to do great with it. I go to great pains to make sure that people are not signing up for something they don't understand. And that's why.
Now, I'm wondering, when you sit down with people and explain this concept to them, what are some of the most common criticisms, or I guess maybe not criticisms, but why do people choose not to do this after you explain it to them? What are the justifications that people give you for not doing this?
Yeah, you could get a higher rate of return if you just put your money in the stock market. That's what, the number one thing, right? Because this is a tagline, a slogan that's been around since the 80s. Buy term and invest the difference. Actually, I think it might even be the 70s when that first came around. But buy term and invest the difference. Whole life insurance is expensive compared to term insurance. If you're 22, go price some term life insurance and then get me to run you some numbers on whole life insurance. I guarantee it's going to be a lot more expensive for the same amount of coverage to get whole life, because the whole life insurance policy has to pay you, right? The term insurance policy is only going to pay if you die in the 20 years or whatever that it's set for. So guess what? It's not going to pay. The chances are very, very low that you're going to receive, that your beneficiary is going to receive the death benefit on that policy. You're probably going to pay a premium for 20 years or 30 years and get nothing. There's no cash value. There's nothing. But you're protected. That's the trade-off. It's cheap. So the conventional wisdom is buy term because it's cheap, and then take the rest of the money that you would have spent on whole life insurance and put it in the stock market. And there are entire companies, which I will not name, because if you can believe it, it's illegal for insurance agents to speak badly about other insurance companies. So I won't say who it is, but there is actually a company that their letter from the CEO at the front of every single policy says, our buy term and invest a different strategy, blah, 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 is like the greatest thing in the world. And they rant and rave about how cool that is. And so they sell you a term policy and a Roth IRA or whatever. And I don't do that. I don't care if you want a Roth IRA, just put it in a life insurance policy first so you can make the money both places at the same time. So, but the problem with that is that, and Dave Ramsey is very guilty of this, he will say, or these people, Susie Orman, there's lots of people who will say the same thing. They will say, okay, your stock market investment is going to earn 8%, 10%. I've seen 12%. Dave Ramsey says 12% in his Total Money Makeover book, I believe. And it's like, really? Okay, so your stock market's going to earn 12% a year is what it says. That's not what it does. That's not how the stock market works, right? That's not how mutual funds work. They go up and down. And that messes up the whole thing. Anyway, I'll harp on that more if you want. And so if you have term insurance and you have stocks or mutual funds or what have you, and you need some money, what do? What if you need money and the stock market is down 40%, right? You're going to sell all of your investments at a loss so that you can go, like repair your house or whatever because your floor flooded because your pipe burst under your sink and you didn't notice for 6 weeks because you were on vacation. You come back home and, oh, I'm sorry, it's a $25,000 repair bill. What are you going to do, right? If you don't have the money in the bank, you can take a loan and pay a lot of interest. You can beg other people. You do a GoFundMe page, right? Or if you're like a well-capitalized, well-rounded, responsible individual who has learned about this, and I mean, that's the biggest thing is learning about it and set this kind of thing up. It's like, you know what? I got a lot of money sitting around, so it's okay. We'll pay this back as we can. You're self-insuring for whatever happens in life. And it's not just bad things, it's good things too. If you get a sweet real estate opportunity, you're good to go, man. Give me 2 days, 3 days, I'll have the money.
Now I have two more questions just about like if we were in the ideal situation. So like let's imagine that for some reason we have libertarian utopia and
I'm with you. I'm on board. Okay.
And we get the banking industry to accept full reserves. And we have trust that these banks are run by libertarians who understand why fractional reserve banking is terrible. Would you still recommend that people take out this policy as opposed to putting their money in a full reserve bank?
Aren't you afraid I'm going to accuse you of being a utopian or something with that question? Okay.
Well, sorry. I don't think that libertarians are utopian, actually. So
no, I don't either. Aren't you afraid I'm going to level some like childish objection at you? That's what I should have said. But no, I mean, I would still say that you want to do this, right? Because, okay, the way that banks are, right? Like we talked about briefly before, you are, it's a stock-owned company or a privately held company, and they have shareholders and they pay dividends or, whatever, quarterly bonuses, what have you, to their shareholders. What you're doing with infinite banking is you're removing those people from the equation. You are the shareholder and you're the depositor or what have you. And so if there's fewer people involved, it's going to be more profitable for the ones that are, right? I mean, that's the long and short of it. But also it's this unique kind of tool. I mean, this has been around for way longer than any of these other things. The IRS, all that stuff was invented way later than permanent life insurance. Okay, we're talking the 1800s, whole life insurance policies were around. And so, all this modern kind of stuff that's playing with some of these ideas, like it's got nothing on here. Now, policy loans haven't existed since the 1800s, but they've existed a long time too. And a bank does not give you the opportunity to utilize your money and do something else at the same time, right? There's a book out there. I've actually not read it. It's called The And Asset. It's talking about whole life, because you get to, go buy a car and get the rate of return. You get to do whatever you want and get the rate of return from your policy. And so it's just, there is nothing else like that. I've seen ads from banks and places like that talking recently about becoming your own banker. And they don't quite say becoming your own banker, but they're like, bank on yourself is kind of what they'll say. And it's talking about using a home equity line of credit. Like, okay, a home equity line of credit, you're loaning against the value of your home. So if the bank is in trouble, they can demand immediate repayment on your HELOC, your home equity line of credit. And then if you can't pay, they can take your house. So, okay. I don't know. I don't feel so good about that, right? The life insurance policy is a separate asset. It's an internally collateralized contract. So if you can't pay, just don't. Like, it's fine. They don't care. The collateral is the death benefit. So when you die, if you don't repay your loan, and it balloons to this huge size, so they'll just say, okay, what's the death benefit minus what's the outstanding loan balance? Okay, equals the amount that goes to your beneficiary. It's a subtraction problem. So that's why I harp on this, like, they don't care thing, because they don't. They're the company that gave you the money, and they're also the company that owes you the money. So it's all good. Banks, it's just, I'm sorry for giving such a long answer to a short question, but like, that is, a bank doesn't do any of that stuff. A bank just says, okay, here's some money. You must pay us back according to this schedule, or we will seize the asset. That's basically how it works.
Yeah. Well, the other question I have is, we often find Austrians, libertarians, we kind of fearmonger a little bit about the economic doomsday. I mean, even myself, like, I'm very concerned about the role of the dollar on the world stage, especially as we're seeing, BRICS, and the fact that Saudi Arabia is opening themselves up to Iran, and our, somewhat dependency on Saudi Arabia for many reasons. And we are now seeing this banking crisis, and we've had people like Peter Schiff for years saying that the collapse is going to happen tomorrow. But what happens if the collapse does come? Would you still recommend a policy like this in the meantime? And even if it does happen, I mean, that is it inflation proof, or if not, is it still worth it?
So it's not inflation proof. And I'm glad you asked this question. It, maybe to some people that destroys my argument or what have you. I don't think that it does. But no financial tool is going to survive. Like, all your IRA money, all of these other things are going to be obliterated if there's like hyperinflation. Okay, so it depends on what you mean when you talk about, like, it's all going to come down, everything's falling apart, the system is breaking up, or whatever. If you want to specifically get into something, like, there's some nuance in each of those scenarios, right? But yeah, we're definitely pessimistic. At least some of us are. I have been for a long time. And the story that I like to tell is that in 08, 09, even 07, quantitative easing, when all that stuff was happening, and they're really pumping money into the system, and we're talking about like tens of billions of dollars, which used to seem like a lot of money once upon a time. That period of time, like, we were very nervous, my wife and I, we were very nervous about what was coming. Like, oh my gosh, it's going to be hyperinflation. We need to buy precious metals. We need to buy, ration packs and water storage, and all these things. We need to get ready because it's coming down. And it didn't. Like, did the dollar devalue a lot? Yeah, it did. But there's still dollars. Like, I've got some, in my wallet right now. They're fine. They can be spent at this current time. They're worth less. but they're not completely worthless, right? They're not being used as toilet paper. And so that is the situation. And if I had done IBC and I had started all this, if I had known about it back then, I would be doing pretty darn good right now, like compared to where I am. And that's not to say we're in a bad spot, but like the value of time, the fact that time is always passing is something you can't ignore. And so I discovered this a few years later. I wish I had discovered it sooner and implemented it sooner because it gets better every year. And so, if you really think that the dollar is going to not exist in like 2 years, yeah, you probably shouldn't do this because it's all going to come down. This is, technically a dollar denominated contract if you want to get particular about it. It's possible and even likely that if the dollar comes apart, but it isn't hyperinflation, the companies will be fine, right? Because life insurance companies are where the money is. Banks are not where the money is. It's in life insurance companies. And like Mises knew this. You look up like in Mises' text, you'll see him reference life insurance companies. So like, I'll broker no argument on this, right? Like it's where the money is. And so for as long as there is a dollar, I think, yeah, go for it. You should do it as long as it's not hyperinflation. Hyperinflation, bets are off, dude. Get your money out and get into some physical assets, some physical things that you can own, like, ammo and food and things like that. That's all very, very valuable in a literal collapse scenario. But again, like we shouldn't be perma bears to the extent that we just will not do anything. I get that a lot when I talk to people. It's like, well, I'm worried about this and this. And it's like, well, 3 years later, you know what? You're still worried about it. Anything happen yet? Okay. Wish you had started already so you could do something. It's not to say I harass people, but because I don't. But the time is always passing, right? Like you hem and haw and don't do anything. And it's like, wow, it's 5 years later. I wish I had done this 5 years ago. And even if you start small, start with a $30 a month policy. I don't care, but start and understand, because you'll start to realize like how powerful it is, especially over time. It'll train you to think long term. And that's one of the most important things you can do, because the crazy psychopaths that like run the world and all that, they're all thinking way long term, right? They're thinking way out. And the only way to fight that is to think long term yourself. So that's my argument there. But if it's like this is the eve of hyperinflation or whatever, get your money out. Surrender your contract, take a policy loan for the entire value, whatever you want to do, however you want to handle it. Call me, I'll walk you through it. Get your money out, get some hard assets while you can. But the bank isn't going to have your money if there's hyperinflation, right? So like, it's not like you can just go get it at a Bank of America and go buy hard assets. You can have it in a couple of days from the life insurance company, and it's actually there because they can't not have it. So that's my case.
Well, your point about the sociopaths that run the country is very true. They are thinking long term, but the way they win is to convince us to think expediently and focus on the short term. And I think that there is just an overall desire for, and the trends are for people to consistently think in short term. And unfortunately, it's also the primary cause for a lot of our problems today.
Yeah.
So I was wondering if we could just, we are over an hour, but could you maybe share like maybe the most impactful testimonial, just so we end on a good notice, since the whole economic doomsday question was a little depressing. What is there a story that stands out, maybe without using names, or if there is someone who would be willing to have their story shared with everyone, just wherever you want to take that?
Yeah, gosh. I mean, it's client privacy, that kind of thing is something I take very, very seriously. And that's something I talk about with people before they sign up for policies and stuff. Like on Proton Mail, using encrypted email and all that stuff. Like, I do not want anybody's information at risk. And so, right now, this exact second, I don't have specific permission from very many people, to talk about their stuff. There are certainly some cool stories, but just have to not say them on air for now. I will say though that, so I have some family that started some policies with my very first clients. Okay. And so it's not my mom and dad, it's other family, but they were my first clients, and they said, okay, we trust you. We know you've been talking about this stuff for a long time. Cause I learned about IBC way before I got into the industry myself. It changed my life, and it just continuously blew my mind so much that I was like, I have to get into this. I have to teach other people how to do it. That's why I'm here, is to teach people. It's not some grandiose like play for money or whatever. It's just like, it's such a powerful tool. I love teaching. And so I got into the industry, and they said, you know what, we trust you. We're going to sign up for these policies, blah, blah, blah. Okay. So fast forward a couple of years, and my, I'll just say my brother-in-law. Okay. So my brother-in-law calls me, and he's like, dude, you mean I can like pay off debt like using this, and it's still growing while I'm doing it, and stuff like, yeah, it's like what I was trying to tell you like for all this time, and so we kind of had this moment, and this actually happens really often, where it's like, I totally get it now. He's like, I'm so excited, I'm going to call people and talk about life insurance. I can't believe I'm saying that right now. Like it just, because it's like discovering libertarianism, discovering like Austrian econ and some of those things, where it's like, wait a minute, everything clicks all of a sudden, and you kind of have this moment where you're like shaking people by the shoulders. That happens sometimes, like for clients. And so they'll be like, I didn't really get it, but like Robert Murphy is a big proponent of this. And so like, I know Bob Murphy's on board, and I know that you are a trustworthy guy. And like, so I trusted some people, and I started anyway. And so my brother-in-law's story is just one of these many examples, but they'll just call me out of the blue and be like, I can't believe this. This is the coolest thing in the world, And so it's just life-changing stuff. They will, and you could read the reviews on my book. Some of the people on there are my clients, on Amazon. Some of those reviews talk about, I got out of debt really fast. I'm, using it to do these different things, these different investments. I have one guy that I just won't use his name. He, came to me saying, I've got $67,000 worth of student loan debt, and I have enough money to pay it off. Should I do that, or should I set up a policy first? And, so we kind of walk through it, and it's like, yeah, it's more expensive to set up a policy first and then do the policy loan and pay it off, and et cetera, et cetera. But long-term, it's so much better to set up the policy, right? And so when these things click in people's minds, that to me is why I enjoy doing it so much. One of the reasons I just really love it, and I get up day after day to do it, is people love it, man. I got a nice note before we came on air, like a few hours ago, from somebody saying, hey, I just got your thank you card in the mail, and, thanks for doing all that you do and all that stuff. It's just like, it just makes me feel good. So maybe it's a self-aggrandizing exercise or whatever, but like, people don't cancel policies once they start them. Like, if it's such a bad deal, how whole life insurance is a really bad place to put money. You'll hear that. If it's so bad, why doesn't anyone cancel and stop paying their premiums? Why do banks put billions of dollars into cash values and policies? Like, it's just, there's no, it's kind of like nobody, becomes like an ANCAP or a libertarian. Like, you don't have all this stuff click in your brain and then go, oh yeah, I guess I'm over that. I'll go back to being like a Democrat.
Yeah.
That doesn't happen to people, right? And so the same thing. People, like, it makes sense. It's true. It's verifiably true. And so when it all clicks into place and you're like, wait a minute, my entire fundamental understanding of finance has completely changed. You don't go, oh, well, I guess I'll just go finance my next car from Chevrolet Auto Finance Company, right? Like, that's not what you do. People don't do that. So
Yeah.
that's my biggest testament, I guess, is just that people don't cancel.
Well, to tie it back to the concept of truth and the acronym that we discussed earlier. It's like many people talk about Austrian economics as being true economics, and that Keynesian economics is the very recent and modern distraction from true economics that has been going on for centuries. And maybe I'm starting to just understand what infinite banking is, but maybe this will be understood in the future to be true finance, because it is grounded in true economics, and it's not grounded in a system that is based off of the illusion of fractional reserves and printing of money. So
Right.
I would encourage everyone to check out your book. It's called Between the Lies. And where can people find it? Where can people find your work? If you want to just pitch your social media and your websites and stuff like that. We'll also
Sure.
include them in the description of the podcast.
Yeah. I mean, I'm on Twitter, Luke H. Tatum. I'm on things like that. I'm not super active on Twitter, to be totally honest with you, but social media, Twitter, Facebook. I know I'm boring. I'm on MeWe, but I don't hardly use it. And I was on Float, and I'm on anything. Look up Luke H. Tatum, and you'll probably find me. But most active on Twitter and Facebook. But my book, you can find it at betweenthelliesbook.com. Betweenthelliesbook.com. You have to include the word book in the URL. Perfect Spiral Capital is my company, perfectspiralcapital.com. Go there and set up a call, talk to me about that. Any of those things. I also have some old work at luketatum.com, which has my old podcast. I haven't recorded an episode in years, but that was called Culture of Peace. That's my my main thing. You saw that mirrored kind of in the intro to the book, where I was talking about peace and spreading peace. That's kind of where that came from. That was a libertarian interview show. Not nearly as nice as this one, but it was good. I had a good time with it. And so if you want to look at some old blog posts and things there, I've got those. It's betweenthelliesbook.com, perfectspiralcapital.com, luketatum.com. You can find everything else from those places.
All right. Well, thank you so much for joining us today. It's been a privilege, and I'm sure we're going to have you back on in the future.
Thanks, Liam. I had a blast, honestly. Thank you so much.
Well, there you have it. I'd like to thank Luke again for coming on the show. This is actually my first time doing a interview-based podcast for Decentralized Revolution. I've done the Ask an Austrian podcast in the past, and I think I might be filling in more often for Aaron, and I might start to do these interviews weekly after this. But we have a couple more podcasts coming up on the Decentralized Revolution series. And if anyone wants to check out Luke's stuff, I'll have the links in the description. I also want to thank the co-producer for this podcast, Simon Kalpin, and thanks to Dave versus Goliath for all of the music you hear on Decentralized Revolution. And thanks to everyone who subscribes to our email list and gives to the Mises PAC at takehumanaction.com. And everyone who shares, rates, reviews, and subscribes to Decentralized Revolution. We do upload to YouTube and all of the audio podcatchers, and we're going to start streaming through Twitter and all of the various sources that StreamYard allows us to do. And then also check out our Twitter account at LP Mises Caucus. We've been doing a lot of the Twitter Spaces, and we're hoping to do that weekly and also incorporate these podcasts into Twitter Spaces eventually, so that we can allow some questions from the audience. I think that will be really fun to eventually have guests be able to answer questions directly from the audience. But thank you so much for listening, and we'll see you next time.